Hey folks, it's Darryl Barnes, President of Deacon Wealth Management. And today's video is going to be all about the LPL financial market outlook for 2023. And I've just gone through a few highlights here from the presentation. We're actually going to include a link to our website so that you can take a look at the entire presentation. But what I wanted to make sure that we covered were the things that were going on in the economy. For the forecast for 2023, we're looking for GDP growth, which is the gross domestic product, which is basically how much the country should be growing in the year 2023, and we're only looking at 0.5%. And the CPI, which is the inflation number, they're looking year over year at an increase of 3.5%. Keep in mind, we've been running inflation numbers close to 8%. For 2022. So these numbers are still not good with regard to inflation. And what inflation is more dollars chasing the same amount of goods or fewer goods. In the case of oil, we're chasing fewer goods at this point due to regulation. But we've got a few things that are going to kind of help mitigate that. One thing that we've got right now is we still have a very hot job market. If you're looking for a job, you can probably go find one. But we're also finding some of the larger employers are starting to see duplicative efforts among workers. So we're starting to see quite a few layoffs as well. So it's kind of an interesting time. We're hearing about layoffs, but we're also hearing about an overabundance of openings for workers. So it's almost, if you can find what you want to do, you could probably go get a job doing it. So there's not enough workers to fill those openings. One thing that I think we're all getting a real good feel for right now is 1/3 of all consumer spending goes to housing costs, and it goes to running your household. If you've tried to buy a dozen eggs recently, you've seen the prices go through the roof. And those are types of things that we're going to have to work through in 2023. Now, all of that sounds like doom and gloom. The one thing that I am very encouraged about is in America, we're very resilient, and we make a lot of independent decisions. I remember thinking about this when President Obama was our president and we started seeing rising gas prices. I would go to the gas pump, spend $75 at that time, which was a lot of money, and not be able to fill my tank. Now we're seeing outrageous gas prices again, but we started to make different decisions. Oh, well, I'm going to start checking the price of the fuel. If I happen to be in an area where I can take advantage of it, I'm going to take advantage of it. And I think we're starting to see that. If you don't need eggs, right now, you're probably not going to buy them right now. You're probably going to shop around a little bit. Maybe you'll go to a Walmart versus a high-end grocery store. I don't know. Maybe you'll get chickens. Who knows? But that is the type of thing that we want to look for. One thing that I also want you to take heart in is stocks have historically risen after the Fed stops their rate hike cycles. What we've been talking about recently is the Federal Reserve has been raising short-term interest rates for the last year, and they've been pretty substantial. And it's because the Fed basically has a couple of tools, one of which is a great big hammer called interest rates. And when they raise interest rates, the goal is to try to slow down money in the economy. So instead of more money chasing the same amount of goods, they'd rather see you put that money in the bank at this point. So we're starting to see short-term interest rates be higher than long-term interest rates, which typically means recession. Recession's not always a terrible thing, but it does mean that there's a slowdown in the economy. That's what the Fed's trying to do. They're trying to slow down the economy. The problem is they can't do it all by themselves. So if you're politically motivated, you need to be talking to your politicians and allowing them to understand that we need some good regulations to go along with the monetary policy to control inflation. You can't use just one tool. There's several tools that need to be at work. One other thing to give you heart is stocks have historically bounced back after down years. The average rate of return is looks like about 12% after we've had significant downturns. And we had a significant downturn last year. So again, take heart with that. I'm going through this very quickly, and I'm doing this intentionally because if you want more information, you're going to need to click this link that we're providing to you so that you can actually get the more detailed information. For your personal situation, you need to call us, come in, we'll talk about it, and I'll talk entirely around the subject so that we can frame the entire context of the conversation to make sure that we're doing what you need to have done to reach your goals and your dreams. One thing that's really good in this rising interest rate environment is that actually less than 10% of all outstanding debt needs to be refinanced before 2025. So there is a chance that the Fed could start reducing rates before 2025, and we'll start to see affordable loan rates at that point, which should help us with our recovery in the economy. This is a very interesting slide. Stocks have always gained a year after the midterms. We just had the midterm elections in November, and this doesn't matter who's in office. The average gain is about 14.7%. The average return, if there's a Democratic president, is 14.5. Average return, if it's a Republican president, 14.8. And again, the average gain is about 14.7%. So if we're able to use history as a gauge, we're hopefully going to return to a point where we're beating inflation and we're starting to make real returns in your accounts versus looking at relative returns. Relatively speaking, last year, Deacon Wealth Management, we did very well for our clients, meaning we didn't lose as much as the rest of the markets, but losing is losing. So we wanted to turn that around, and our portfolios are actually adjusting, and they're working very well right now. One other thing to give you hope is a Democratic president with a Republican or a split Congress has always been a strong combination for stocks. If we've got a Democratic president with a Republican or split Congress, with a split Congress, it's 15.9% is the average return. This is going all the way back to 1951, so we're looking at basically 75 years of returns. If we had a Democratic president with a Republican Congress, the return is typically 18.3%. So right now we are in a split arena. So probably not going to set the world on fire, but again, this is where we start to show our resilience. This is where we start to show our consumer preferences, and that's why it starts to work out for you. If you'd like more information, please call us at 540-371-8585. This has been a very, very brief presentation on a very detailed amount of information. There's no other way to do this other than to sit through about an hour-long class with me, but I'd like for you to hit the link at the bottom of this video. Take a look at the details that I've gone through. I've only hit the highlights. There's a much longer presentation to go along with this. And with any additional questions, come in and talk to us. We're happy to help you with your own scenarios. And again, my name is Darryl Barnes, and I'm the president of Deacon Wealth Management. You can always reach us on the web at www.deaconwealth.com or call us at 540-371-8585. We hope 2023 is going to be a fantastic year for all of us. But if you're worried about how we're starting out, give us a call. Hopefully we can ease your mind. If not, we'll at least give you perspective. So thank you very much for tuning in. Take care.